Well, the spike in reverse repos continues and has now set a new record. Overnight reverse repos hit $475 billion today. That is apparently a record. I guess the old record was around $450 billion. And I've talked about this topic numerous times, and it's I've struggled with it more than anything, I think, in the entire time I've been doing this channel, with trying to understand what exactly the issue here is. Because I recognize that this is not normal, that it clearly seems to be signaling some kind of issue, but I haven't been able to really wrap my head around the nature of the issue. But I'm starting, I think, to comprehend it a bit today. I'm not totally comfortable with it yet, but I think I'm starting to hit a bit of a breakthrough with this, because frankly, anybody else I've heard talk about this or write about it, they just haven't presented the case as to, hey, here's why this is bad. Here's what this will lead to. They just kind of say, oh my gosh, look at this. Reverse repo spiking. Isn't this terrible? Zero Hedge, for example, has been very cryptic about all this. I think they just keep, posting this this clip from some movie of a fat guy eating a bunch of food and then exploding. And they're saying, this is the banks. Look, the banks are going to explode. They're full of money. But what hit me today is that the analogy of comparing reverse repo to essentially undoing QE. And I've heard this before, that the way that reverse repo works is that the Fed, when they do QE, they print money and they hand it out to the banks, and they buy treasuries from them, T-bills and longer-term bonds, but mostly like short-term U.S. federal government debt. They buy that off the banks. They give the banks cash. That goes into their account at the Fed. Well, reverse repo is the opposite. When these banks present the Fed with their cash and say, hey, let us have some of those bonds back. We need to borrow those overnight because we want some of those bonds. And this effectively reverses the process of QE. And so you need to look at an overnight repo when it hits $475 billion or so as $475 billion in balance sheet runoff. This is, in effect, the commercial banks and whoever else is participating in this reverse repo in forcing the Fed to taper and to actually unwind QE to a certain extent. And this is no small sum. We're setting records here, and the previous records, were all set on essentially single days, end of quarter balancing, which very quickly went down the next day. Because I guess I'll explain that. The reason why you see these big spikes in the repo market, or in the reverse repo market, if you look at the charts so far, because this is a fairly new thing. I believe reverse repo was only introduced in 2013. The spikes that you see are at the end of the quarter. These banks like to put really safe assets, I guess, onto their portfolio or onto their balance sheet, and so they borrow a bunch of treasuries from the Fed right at the end of the quarter, because that just makes them look a little better when they're, when they report to their shareholders. But then at the first day of the next quarter, that drops back off and it goes back down to normal. But right now we're not at the end of a quarter. We're in the middle of a quarter. So this is not connected to that. This is just sustained, record high reverse repos. And so there's no real sign that this is going to end, that this reverse repo usage is going to draw down. I guess until the federal government starts issuing significantly more debt than it is right now and starts running much higher deficits. Because the bond market has effectively hit a wall. The Fed has purchased so much through quantitative easing of the Treasury market that they own the Treasury market. They control so many treasuries that the banks now, when they want to get treasuries, they have to go to the Fed. They have no other choice. That's the only source of treasuries right now. And so what that means is that the price of treasuries is likely hit a wall, because the Fed doesn't want to let treasury prices go negative. I guess the Fed now has a choice. Either they can let the treasury market go negative, like Europe has, which the Fed has said, hey, that doesn't work, we can't do that, which is true. I mean, I guess I'll at least give Powell credit for saying that negative interest rates have not worked out well in Europe. But the alternative is that bond prices can't keep going up. The bond prices in the United States have been in a bull market since the early 80s. I guess you could peg it around 1980, 81, whenever yields peaked under Paul Volcker. And ever since then, anyone who has bought a bond, has made money because bond prices always go up. And this is, of course, thanks to the Fed. The Fed's been propping up the bond market for 40 years now. Over 40 years. I guess, we're getting close to 41. But now they've bought so many bonds, so much of the bond market in trying to push the price higher and higher by keep boosting demand. Because the thing is that the Fed can't just prop up bond prices. They have to keep pushing them higher and higher and make sure that the price keeps going up and up. But once you bounce off the zero lower bound, the price of bonds can't keep going up, unless the yield keeps falling lower and lower. And once you hit zero, yields have to go negative for bond prices to go up. And the reason why the Fed set up the reverse repo facility, as they call it, was to ensure that bond prices or the bond yields never do go negative, so that at any point, if bond yields get so low because demand is so high, banks have the opportunity to go do reverse repo and get the bonds they need, and then that will keep the bond, that'll keep the yield pegged right at zero. Which, if you look at a U.S. 1-month Treasury, it's it's like yielding 0.001 or something like that. The only reason why the 1-month T-bill and the 3-month and 6-month probably have a positive yield at all is because of reverse repo. There's been, right now, $500 billion in reverse repo. That means that about $500 billion in the Fed's balance sheet has been unwound. That is an unwinding of QE. And as we learned back in 2018, if it wasn't clear enough already, when you start unwinding the Fed's balance sheet, the financial system will come apart. There's no way around that. That's why Powell, reversed. He ended he stopped raising interest rates. Then he quit balance sheet runoff on QE, because remember, balance sheet runoff was on autopilot. The Fed was essentially doing, reverse repo back then, in that they were letting these bonds fall off their balance sheet and go back into the commercial banking system. The commercial banks had to pick up the slack and buy these bonds that the Fed was no longer buying through QE. And things started to come apart. We hit, I think it was it March of 2019 when we hit the lows? It was somewhere around like 2,100 on the S&P, if I remember correctly. In other words, a more than a 50% drop from where we are right now. That's where we were back in 2019. And then the Fed finally said, you know what, screw it, we're going for QE infinity. And we're just going to keep buying bonds out of the bond market in perpetuity. What the Fed called permanent open market operations. And the point of this was to continue inflating the asset bubble, because the Fed said, gee, if we just let our balance sheet run off, asset prices will fall, because all asset prices are predicated on the rising prices. It's a pyramid. It's a pyramid of asset price inflation that starts with the U.S. Treasury market. And so as long as the Federal Reserve keeps pushing up the price, keeps increasing the market value of U.S. Treasuries, the price of everything else, on average, is going to rise as well. And the reason for this is that as you lower bond yields, you push people out the risk curve in order to get, people have to take on riskier and riskier assets in order to achieve the same rate of return. But if we're at the point to where the Fed's QE has run up against a wall, and now the banks are just taking advantage of more and more reverse repos, well, then that means that the Fed can't continue to push the Treasury market higher and higher. That is, unless they allow rates to go negative, which, so far, I tend to be someone who takes the Fed at their word to a certain extent, within reason. And, like when Powell says, I'm not thinking about raising rates, I trust him. I think he's telling the truth there. I don't think that he secretly wants to raise rates. I think that if Powell ever wanted to raise rates, he would absolutely telegraph it 10 years in advance before he ever did anything. And, I tend to think the same way about the negative interest rates. Powell's been pretty consistent saying, hey, they tried negative rates in Europe. We don't want to do that here. And, he has good reason to believe that. It didn't go well in Europe. Europe's not in a good place economically or financially. But at this stage of the game, this whole pyramid, this whole Ponzi scheme is going to collapse. This whole house of cards is going to collapse if rates, don't go, if yields do not turn negative. Because right now, if rates just sort of bounce off of zero and reverse repo keeps ballooning, as the Fed pulls, more and more treasuries out of there, the market sucks more and more. It has to, go reverse repo to get those treasuries back, just to keep the rate, just to keep rates from going negative. Well, then the price of these bonds, I think, would have to stagnate if the yield is not changing. If the yield's not changing, the price is not changing. The Fed can't let yields rise because that would kill everything. But they also don't want yields to go negative. So therefore, the price just sort of has to stay pegged, at the same. And therefore, all asset prices will necessarily stagnate. Which, I hadn't thought this through until just now. But stagnating asset prices at a time when, the Fed is monetizing, U.S. federal debt, and generating a bunch of consumer price inflation, gee, looks like stagflation as a best case scenario. Oh, and the other thing is, the Fed can't let yields rise because the federal government, is running massive deficits. They have, are we at $30 trillion in debt yet? And most of that is short-term stuff, T-bills and stuff. They can't let rates on T-bills spike. Because that would bankrupt the federal government. Now, something to consider is that currently the Fed has a limit on how much reverse repo can be conducted, and currently that's at $80 billion per counterparty. So each bank or whoever goes in there for a reverse repo is only able to hand the Fed $80 billion in cash to get $80 billion worth of treasuries. Now, as of today, we're not, I don't think we're near there being an issue with that, because on average, there were apparently 50 counterparties today. I think I did the math. It comes to around 9 billion or 9 to 10 billion per counterparty on average in reverse repos. But you have to think there's a bell curve there, and the folks at the at the far end of the bell curve, I don't know, they might be pushing up against that 80 billion cap. And so is the Fed now going to raise the cap on reverse repos? Are they going to remove the cap on reverse repos so that there's as much reverse repo as necessary to keep rates from going negative? Because that's exactly what's going to happen if you have these institutions who want more than 80 billion in treasuries from the Fed. They're just going to have to, and if they really want those treasuries, they're going to pay for them one way or another, and that in and of itself could push yields negative. And I think the reason why, Powell correctly cited in the past why he doesn't think that we here in the United States should engage in negative interest rate policy is because of the stagnation that follows it. You don't get, a booming stock market from negative interest rates. You don't get a booming real estate market. You get a stagnant market. So I think the Fed is going to have to make quite a few difficult decisions. And there's no good options here. As I said, in a video I'm going to keep referencing, I think it was called The Three Roads to Economic Ruin. And, it's got a thumbnail there with Powell and Janet Yellen, both of them. To where I say there's no good options here. It's going to go down bad. But it's a matter of bad how. What kind of bad are they going to choose? And at this point, I think we may be reaching the QE endgame, and I'm not an expert on this. I'm just trying to reason through this by looking at what's going on, figuring out why these things are going on, and how this can change. And the simple answer is, even if we don't get a crash, I don't see how things can continue to grow. Because this has all been because of Fed policy, because the Fed has been giving us free money. But if there's nowhere now for that money to go, if the Fed's quantitative easing is in and of itself creating instability in the plumbing of the financial markets, well, then that tool of theirs has been effectively neutralized. We may be about to enter an effectively post-QE America, and I don't know what that looks like. So I'll continue thinking about this and hopefully come up with an update later when I develop this a little more. And again, if any of you have any resources to link to that actually has any real answers about this and tries to explore the real implications of this, I would greatly appreciate it.